It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. All right, welcome back. Managing Your Financial Future. Johnny Dean, podcast host here. Thank you so much for joining us. This is, we've been off for a couple of weeks. Professor Rick Plum, certified financial planner professional, here with me once again. Hello.
Hello.
We are in new digs yet again.
Yeah, but these are the final ones, right?
Well, they're getting close to the final ones. People don't, they don't know where we're doing this, but
we moved our studios.
And now we were in temporary studios while we moved to the new studios, and now we're mostly in our new studios. So but if we sound better.
There's still a lot of equipment I see sitting around that's not hooked up to anything.
There's a lot of equipment. There's a lot of bubble wrap, but we're getting there. We've been off for a couple of weeks here as we start. This is a new season, but we're going to kind of stop this whole season thing.
Just call it episode X.
Exactly. It gets to be a little bit unwieldy at that point. But anyway, thanks so much for joining us. A lot of stuff to talk about here. We could go any number of directions. I wanted to get with you, Professor Plum. I wanted to get into this whole idea. The overarching idea has to do with the transfer of wealth from generation to generation. And I'm seeing some of it with myself right now. Other people our age, they're starting to see it. It's always been going on. But, I mean, inheriting things. When you inherit assets, there are oftentimes different rules that have to be applied. But even if you aren't inheriting them, everybody has certain required minimum distribution rules. And I wanted to get into that first.
Well, and we've been off for a couple of weeks, and while we were off, the IRS has issued some new guidance on required minimum distributions for beneficiaries.
Isn't that just like them to do that while we're on our break?
Well, as you remember, we have new rules for beneficiaries of IRAs as of basically 2020. For somebody who passed away in 2020 who had an IRA, their beneficiary, their non-spouse beneficiary, has new required minimum distribution rules. In the old days, that non-spouse beneficiary could stretch. They could take the distributions if they wanted to. Now,
well, we're talking about IRAs.
IRAs, 401ks, yes. Qualified retirement plans.
Yes.
It's what in the old days we had. Old days, 2 years ago.
Well, it was
if they died
prior to 2020,
right? So if you were a non-spouse beneficiary, you could stretch it over your life expectancy. Now, I'll tell you that most people didn't do that. They took it out within about 3 days.
Well, you did see that.
But it also depended on the size of the account. If the account was $20,000, they just took it all out. If the account was $2 million, a lot of times they wanted to, manage their taxes, so they were able to stretch it over their life expectancy. And so if they were in their 30s, 40s, 50s, they could stretch it for quite a while and not have a huge tax bill all at once.
And the reason they would stretch it is because if they took out all if let's say it was a $2 million IRA that they inherited, if they took it all, they were going to lose a lot of taxes. Because
that's, $2 million taxable event, that's definitely putting the majority of that distribution at the top tax bracket federally, and if you live in a state, that's the top tax bracket state for most people too.
So if they could take it out in smaller chunks, it eases the tax burden.
You've got the lower brackets for a lot of people in those areas. Now Congress changed that rule in 2019. So for people who died in 2020, their beneficiary had a required minimum distribution that was not able to be stretched over their life expectancy. They had a 10-year rule. They said, now the IRS came out with guidance, trying to interpret what Congress's intent was
in 2020
and early 2021, and said nothing has to come out. Now, if you're subject to this new rule, not everybody, not even all non-spouses was subject to the new rule, but most people were subject to the new rule, 10-year rule. If you were subject to the new 10-year rule, you didn't have to make any distribution for years 1 through 9. But by the end of the 10th year, it all had to be out.
So if I inherited an IRA from somebody who passed away in 2020, I could do nothing. I don't have to. The interpretation at the time was I could do nothing, leave it alone, but everything has to come out by
the end of the 10th
year. End of the 10th year. Prior to that, if the person passed away in 2019 and I inherited it, I had a required minimum distribution based on my life expectancy.
Right, and you had to start that
and I
the
had to
year
start
after
the
the year of death.
Yes, so I couldn't do nothing. 2020, they said, you can do nothing if you want to, but it's all got to come out by year 10.
And and most people, though, when we had people, especially inheriting larger ones, they were taking money out the first year that they did, even though they weren't required, because let's say it was that $2 million IRA. They were taking at least some amount out, trying to use the lower tax brackets of today, rather than just leaving that $2 million IRA to grow for 10 years when it could be $4 million or $3 million, and then taking one lump sum of one big chunk of tax, a taxable event. So a lot of people were taking at least some out. Well, we're glossing over some of the rules, but we're talking about people that are subject to this new 10-year rule. The IRS, 2 weeks ago, I think it was now, I can't remember the exact date, has issued updated guidance. Bless their hearts.
Updated guidance is never good for us.
Well, it changes the way things are happening. Now, and it didn't change the no distribution rule for everybody for 9 years. It changed it only for those who the owner of the IRA was in the RMD stage.
The original owner.
The owner of the IRA, if it was my dad, your dad,
yes.
Your uncle, they leave you an IRA. They died in 2020 or later, but they were taking required minimum distributions from their account.
So the guidance changed for people who were already of RMD age.
Yes. The beneficiary of that individual has to start taking required minimum continue taking required minimum distributions from the IRA at least as fast, or using your own life expectancy if it gives you a better number, for the first 9 years. So it's basically the stretch IRA required minimum distribution for 9 years, and then whatever's left, taking it out it has to be completely depleted by the end of the 10th year.
Okay, so
they didn't. I guess they went back and they redid their checkbook, and they realized, wait, we just lost a lot of cash flow coming in. I know you don't. I'm just playing.
I'm letting it go. I'm letting it go.
And they said, wait a minute, we want that tax dollar to show up so that we can say that we're balancing the budgeter a little bit. I don't know, but they said we can't let you go for just 9 years without taking a distribution. You got to continue doing at least an RMD, basically under the old rules, for up to 9 years, and then you have to take 100% of it out after that.
Okay, so if I inherit an IRA, we'll call it, from somebody who was required minimum distribution age and had been taking RMDs, right? So that's somebody who's currently over age 72.
Right.
They were taking RMDs. I inherit that IRA from that person. I now have a required minimum distribution
starting the year after the year they died,
and that required minimum distribution can either be theirs or based on
either
mine.
Base it on their life expectancy or your life expectancy.
Does it matter if it's in my name? Well, it would be in my name.
It would be a beneficiary IRA in your name now.
Right. So I could do either one.
Right, whichever one works best for you.
Like whichever might be lower potentially.
Right, but, it's one of those things. But
okay, so
typically everybody's going to base it on their own life expectancy, reduce it by one, but then it's still only a 10-year payout.
Yeah, so what that could lead to is I say, okay, I'll take a required minimum distribution. Let's say I'm in a high tax bracket. I really hate to add to my income, but I will.
And maybe I'm going to retire in 6 years, 7 years, 8 years, and so I'm going to be in a lot lower tax bracket in the future. So I'll dribble and drab it out for a little bit, and then take the hit later on when I might be I'll have more room in the lower brackets. All of this depends on the size of the IRA. All of this depends on what you're trying to accomplish. And as I said earlier, a lot of beneficiaries don't seem to care about the taxes. They just take the money.
Well, that's the other side of this. We talk a lot about required minimum distribution rules, beneficiaries, and things like that. To many of them, maybe to most of them, this is found money. And it's, heck, all right, so I pay taxes on, let's say it is a $2 million IRA.
I still have $1.2 million in my pocket.
And I'd say, well, wait a minute. You mean I can access $1 million plus right now? I'll pay a ton of taxes, but
it's still $1 million.
I get $1 million plus
before.
I didn't have before. Well, why would I want to wait 10 years and maybe pay a little less than in taxes?
Well, I would say it's unusual that somebody would need to spend $1 million in 1 year.
Well, It is.
And it's much more tax efficient to take it out at a slower pace. I mean, we're talking about the bigger IRAs, not the $10,000.
Oh, no, absolutely.
In fact, a lot of times when they're $10,000 and $20,000, it's like, just take it out and get it over with. Don't deal with it. Don't worry about it.
Look at lottery winners. I mean, what do people?
The statistics are horrible.
with lottery? What do lottery winners usually do? You win $80 million. I mean, they say, well, you can take it in chunks over the next 29 whatever years in some cases, or you can have it all now, but you're going to lose. You get two things. Let's say you win, $10 million.
That $10 million is the cumulative payout over 26 years for most of them. And if you want it in lump sum, you're only going to get about 6.5.
Right. Well,
but then that 6.5 is fully taxable, at least at the federal level. Many of the states, even California, if it was a California based lottery, or not based, but it's one that's in California, you don't pay California tax on it, which is unusual. But,
well, it is, but let's not say that too loudly.
Yeah, they may figure it
nor
out.
Social Security taxes
some
either.
States do tax, but yeah. So you get the 6.5, you pay taxes, you're down to 4. So instead of getting 10 spread out over 26 years, which you get to pay taxes on as you receive it, but you probably pay it in a lower tax bracket. You get 4 that you can do whatever you want with right now.
And what people do is they say, "I'll take the 4. That was 4 I didn't have, so I went from 10 to 4."
Yeah,
I'll take it now.
And unfortunately, the average person winning the lottery, this is money that they've never experienced this kind of money before, and they don't know how to handle it, and it just can't run out. So yes, it can.
Absolutely, it can. And it can happen to people with IRAs too, by the way. I mean, found money is often dangerous.
Well, pivoting to this can happen to people that take the lump sum payment from a pension plan. So instead of getting a monthly check for the rest of your life of X amount of dollars, you get a lump sum and you put it in your IRA. I've seen this happen where they could have had $3,000 or $4,000 a month, but they took $1 million or whatever the number worked out to be, and it's just such a large. They're rich. They never expected to have that kind of money in their investment account, their bank, whatever they want to call it, and they spend it.
It will
never run out.
They've never seen 2 commas in their their bank account balance
on their investment portfolio before.
Wow, that's a 7th number, right?
And we're not including decimals at
all.
No,
we're not. These are commas. These are not dots.
And they end up spending it like it'll never go away.
I don't think some people are even aware that many pension plans will offer a lump sum based on the.
Not everyone does.
No, but many of them do. That they will offer a lump sum or give you an annuity payout. Now, what is the lump sum for a pension plan based on normally?
Oh, it's based on an applicable federal rate. It's based on a government rate, which right now favors the lump sum for a lot of people. That doesn't mean you should be taking the lump sum.
You should do the math.
Yeah, you do the math, and it also depends on where that lump sum is coming from. There are that's for private companies, not public entities, not teachers. I know that in my area, the state teachers retirement system, the lump sum is not a good option. It is what the teacher has contributed from their paycheck over the years that they work there, plus interest. Mm-hmm. But it does not have any kind of what they call actuarial equivalency to the check that you're going to get if you take the monthly check.
What is it? Just a made-up number?
The check that you're going to get is based
on
years of service.
But the lump sum.
The lump sum is not. See, if you have a private pension, the lump sum is a derivative of that monthly paycheck.
Absolutely.
They say,
just like the lottery in some ways would be.
Say, how much do you have to have in a pool of money today
to create
that income stream over the normal life expectancy for the age of that individual based on the government rates? And so they back into the lump sum. With the local, the state that I live in, their lump sum is what the teacher paid in plus interest. It doesn't include any money from the state. It does not have an actuarial mathematical basis as compared to the monthly payout.
Yeah.
It's usually, if you look at the break even, it's usually like 8 years, 7 years. If you're going to be getting a pension of $50,000 a year, you might get a lump sum of $350,000. Now, $350,000 sounds like quite a bit. But compared to $50,000 a year for a 55-year-old or 60-year-old,
Well, 350,000. I mean, what are you going to get out of that? About 15 grand a year, maybe.
But you're looking. Remember that when you die, that 350 does. When you die, the pension goes away too.
Well, no,
so it's a little bit different
true.
math. But
all right, but
it's basically you're looking at. It's probably only 300,000 too. The numbers don't equate now in private practice. It has to equate. The government regulates it, and so that lump sum on that $50,000 may be like $800,000 or $900,000.
Wow. Well, I tell you, I mean, this and that's another topic we've talked about in the past too, which has to do with deciding whether or not you want to do the lump sum or the annuity option with.
And some of that decision making comes back to the original intent of today was, do we want to make sure that there's something to pass on to the kids? Mm-hmm. Now, that could it can make the decision go either way, because it may be such a great payout on a monthly basis that you could leave the rest of your portfolio to grow. Yeah. So that would be the better choice. Or maybe not a very good payout because the interest rates are so low that the lump sum might be a better deal. It also goes to, how long might you live?
Well, that's always when you don't know the answer to that question, it makes the math a little bit more difficult to do. Having that unknown, it becomes a guess. Really,
I hope it's a guess all the time.
Well, you can make an educated guess potentially.
I've only had one person, when we're talking about these things. So, when might you pass away, sir, ma'am, whatever. And this one gentleman sitting across the table from him, he was, probably 65. I can't remember at the time, mid-60s. He said, January 18th, X year. I'm like, and it was like 12 years away. I'm like, that's pretty specific.
Yeah, it's very specific.
He goes, well, that's when my twin granddaughters graduate from college, and after that, I'm not needed anymore, so I'm probably out of here at that point. I was like, whoa.
Wow.
But I've never had anybody give me that specific of a date before.
Did you ever check to see if...
It hasn't been 12 years yet.
Oh, it hasn't yet? Oh, all right. Well, hey, everybody's got their own thing. Now, we were going to pivot to something else, too. And
we were talking about the required minimum
popped out of my head,
and just different aspects of wealth transfer, and things that I've run into in the last couple of weeks. One was this new rule on the required minimum distribution.
Yes,
but we're dealing with taxes a lot right now. We got a lot of people who have just filed. Maybe you filed a couple months ago. Maybe you've even got your refund back and spent it already. I don't know.
I would hope not.
But we're just at the after tax season for most people, and it's still fresh in our minds.
Well, it is. Now, I just thought of what it was. At the end of last year, for some reason, there were a lot of capital gains distributions and things like that. That was one aspect of it.
It was a pretty high capital gain distribution year.
It was for people that own mutual funds and things like that. And for some people, it caught them by surprise, and it kind of messed them up from a tax standpoint. But you were talking before we went on the show today, about people who had inherited portfolios from their parents and had not thought about what we call resetting the basis. Well, can you talk about that?
Yeah, there's a lot of things that go on. If you're inheriting IRAs, you have to deal with the required minimum distribution rules. If you're inheriting personal assets, you probably want to make sure that, especially if the person has owned it for a significant period of time, you want to make sure that you have a new basis.
What do we mean by that?
Basis is the starting point for determining capital gains. For most people, it's what you paid for it. So if I paid $10 a share for a stock, my basis is $10 a share. It goes to 15. If I sell it, I incur a $5 capital gain. I paid 10, that's my basis. It grew to 15, I sold it for 15. That extra money, that the appreciation, is my realized gain.
You pay taxes.
I pay taxes on that $5. But if I own that stock, when I die, it's worth $15 when I die.
You paid 10 for it.
I paid 10 for it. My wife or my kids, somebody's going to inherit that money, that stock. Mm-hmm. They get to reset the basis. They get to reset it as if they had paid for it the day I died. So when they look at their starting point for taxation, it's as if they bought it the day I died. So their basis is now $15.
Which is better for them if they sell it right away.
Usually it's better for them because it is a resetting. We call it a step up in basis.
But it could
But the reality is it's a resetting of the basis.
Yeah, because it could step
It could go down.
Yeah.
I mean, and we saw this in 2009, 10, 11. Unfortunately, people passing away at that point when they may have bought it in 2007 and 8 earlier.
And they cratered.
Or, early 2000s when they were buying some of those tech stocks for ungodly amounts of money, and then it was worth nothing afterwards, and they don't even get to take the tax loss at the point. The nice thing, though, is, yes, it's as if I bought it on the day that the person who I inherited from passed away, but even if I sell it the next day, it's a long-term gain. Inherited money's
which is a lower tax.
Yeah, right. But I was talking with somebody the other day, and they had inherited a nice portfolio from their father, late 2020, and it really it was a big mutual fund portfolio, big names.
Right. These were all equities, stocks.
They were almost all stocks. There was some balanced portfolios, but the majority was like 80% mutual funds.
And this is something that the father had owned for many years,
and he hadn't needed it. He had
let it grow.
He just let it grow for a long time. They inherited it, and they were caught on their 2021 tax return, the inheritor, the beneficiary, because the mutual funds issued fairly large capital gains.
When did this person pass away? Was it
late 2020?
Okay, so they've had this now for a year and a half or so.
Right, and then in 2021 there was quite a bit of capital gain distribution. That's what happens when a mutual fund sells its assets internally, creates a gain internally, and then it has to pass that gain on to the existing shareholders at the end of the year. And they were not aware that this was going to happen, and it kind of messed up their Affordable Care Act subsidies for 2020. Yeah. They had to pay back some of that subsidy because they were getting their health care through one of the exchanges. And then when we were looking at it, it's still their statements still showed a significant amount of gain, what they call unrealized, or what other people call paper gains. Going back to my $10 to $15, if I bought a stock for $10 and it's now worth $15, that's a paper gain. It's still, I own that stock, and that gain is there, but it could disappear. So on paper, it looks $5, but by the time I get around to selling it, it could be more or less. I don't know exactly. In the accounting world, that's called an unrealized gain. And so on her statements, it was showing a significant, even after the large capital gain distribution at the end of last year, which was close to 20% of the overall portfolio, it was still showing about a 30% unrealized gain potential, paper gain. And I was thinking, in 1 year, I mean, that's like a 40% run up in 1 year into 2021. And I looked at some of the gains, the reported gains on the mutual funds through Morningstar, through Yahoo, and those kind of things. And they didn't show 40% gains. And so I was asking the individual who had inherited, I go, was this basis ever reset? And they have no idea what I'm talking about. So they're calling to make sure that the basis was reset as of the date of their father's passing.
So in other words,
which means that when they do sell this, if they do sell it during their lifetime, they won't have to pay They won't have to pay tax on the gain that happened during their father's lifetime. They only have to pay tax on the gain that occurred since they inherited it during their ownership time.
So what their problem was, they were using probably their father's original basis from, which was years and years
1947. Ago. I don't know. I'm kidding.
Well, yeah. This is and this is something that what you're saying is for people who are inheriting portfolios, especially those that have been held by an individual for
long periods of time,
and have, let's say they have a lot of gain.
Right.
If they had a portfolio that was worth $20,000 in 1975, and now it's worth $200,000. I don't even know. What they have to do is reset the inheritors, the kids, the beneficiaries have to reset the gain and say, well, wait, no. This person died a year and a half ago. That original $20,000 that it was worth, his cost basis,
it really doesn't matter anymore. What was it worth the day they died?
Right, and that will help you to avoid. Why do you have to? Do you have to let everybody know that the basis has been reset? I guess. How does that work?
Yes and no. It's not you have to let everybody know, but I would let everybody know just to make sure that they actually do it. because unfortunately it does slip through the cracks at times. They may change the name on it from your Uncle Bob to John Dean. Okay, so they changed the name. The money came across, but did they reset it? Sometimes it slips through the crack. It didn't. Make sure they reset the basis.
They meaning
whoever the brokerage company is that owns them. You're either owning, if you own mutual funds or stocks, you're owning them directly with the mutual fund company, or you're owning them through a brokerage company, brokerage account. Make sure whoever is holding those shares for you resets the basis.
They may or they may not.
Right, and if you have real estate.
That's another one and
real estate's a big one because especially lately there's been quite a bit of appreciation.
Only over the last 20, 30 years, whatever it was.
You would want to, unless the people bought it 6 months before they passed away, this house is going to be the death of me. I'm sorry.
Go on, yes.
But have an appraisal done. And so that when you ultimately do sell, if it's someplace that you're going to live in, you want to have the appraisal done so that you can reset the basis going forward. And
that's a little harder to do, I guess.
So you just put the appraisal in the file and you wait.
You don't technically you'd have to have it appraised as of the date of death.
There are appraisers that specialize in that, depending upon how long ago it was.
All right, okay.
But that's why these are the a lot of times people say so and so passed away. What do I need to do? Well, you need to get a listing of all the assets and get a valuation of all the assets. So this is one of the things that if you're the trustee, the executor, however it's being set up, these are the steps you go through. Get these things done. Now, it will really help also, especially a property that's been held for quite a while, if you're going to turn it into a rental property. Maybe mom and dad bought a rental property for $100,000 back in 1985, and they've been renting it all along. They've been depreciating it, so they've gotten the use of it. Now they pass away and they leave it to you, and it's worth $700,000, $800,000 now. I inherited. Remember, it's as if I bought it today. So my basis is now $800,000.
In your example.
I get to redepreciate this thing. All depreciation is a non-cash deduction on your tax return.
Yeah, yeah, that's true.
And so you get to offset the income that you're renting it for with this depreciation. So you get to have cash flow today that you don't have to pay tax on.
And you don't have to recapture their depreciation.
You don't have to recapture their depreciation.
But you start a new depreciation.
You start
schedule.
a new one. So their depreciation was based on, let's say it was a condo, so we don't have to deal with land because land doesn't get depreciated. They got to depreciate the $100,000 over 27 and a half years. So basically, $3,000 a year. They were taking $3,000 off their tax return from the income coming in. Now you're going to redo it and depreciate $800,000,
which is a bigger number.
Which is a much bigger. I'd say about 8 times as big. So that's about a $24,000 deduction from income.
Well, no, and that's important. What you're making sure people understand here, and I'll keep this simple. That is, if I inherit from let's say my father, whatever. Let's say a stock that he paid $20,000 for 50 years ago. And I inherit
it was
the stock.
Apple stock from 1994 when it was $4 a share.
Yeah, whatever it was. But let's say he paid $20,000 for it. Now this portfolio has grown. You never did anything with it. It just grew and grew and grew, and now it's worth $200,000. And I sell that stock. Let's say I just say I'm going to sell the whole thing. I inherit it. I sold it, 2 months after he died. So
very little growth,
very little change, if any. I need to make sure that the basis is no longer that everybody knows that needs to know that the basis is not what my dad paid for it at $20,000. The basis is
what it was last month.
What it was, because otherwise, if I sell this stock and nobody knows that the basis has jumped up in my example, I'm going to wind up paying capital gains taxes on something
unnecessarily.
Yeah, and
I said it before. We're not happy about paying the taxes we have to pay, that we legitimately legally owe. We really don't want to pay more taxes
you're
on
not
things
required to.
Yeah, that's just not right.
Well, it isn't. So if you're inheriting something, you're saying make sure that the basis was reset one way or the other.
Yeah, I mean, I've run into quite a few people who have very large positions in a individual stock or in a properties, whatever the case, and they don't necessarily need the money, but they're not going to sell that stock until they die, because one, they don't know their own basis. They bought it, back in the 70s and the 80s. They, put in 20 here, 10 there. I don't know what I paid for this thing. And back then, the brokerage companies didn't keep track of. Well, they may or may not have kept track of the original basis.
Maybe they reinvested the dividends over and over.
They're like, I'm just going to hold it till I die.
Yeah.
And hopefully Congress will continue this rule, this what they call step up in basis rule, in the proposal last year, the BBB proposal. They were talking about getting rid of this rule and creating what they call a carryover basis, where the basis carries over to the inheritor. And
I think it had to do with your income level. I don't think it was for everybody.
It wasn't for everybody, but that income level moved around a lot. And and the fact is, that if you have to, let's say you inherit, a $500,000 or $600,000 investment portfolio from your parents, and they bought that Apple back in 2000, or 1994 when it was $4 a share. Now you sell it for $500,000 and you have a $480,000 gain. You're over what they called the $400,000 limit. You're subject to it.
You are subject.
You didn't get the step up. There's some weird stuff out there.
Who knows?
But, so for now, I don't like the carryover basis, because a lot of times, especially the older generation right now that are carrying large assets, they don't know their basis, especially on the real estate side of things. They have no idea what their basis is. So how are the people that inherit it going to know what their basis is being carried over from mom and dad, grandpa, grandma, Uncle Eddie or whatever?
Well, how would even the IRS know?
They're going to make liars out of everybody.
How would the IRS even know? If the person said, okay, IRS, you say owe taxes, tell me what the basis is. The IRS isn't even going to know what it is.
But unfortunately, I think this is an area where the IRS could say, we don't accept your number, prove it.
Well, I could say, I can't prove it, so tell me what your number is.
And they'll say 100%.
Oh, well, no, they can't. Well, you mean to say that it was bought for zero? It's 100% taxable?
But they will go for the biggest number they can go for.
Maybe. I honestly think it'd be too much of a headache.
I think, and that's why I hope they don't get rid of this rule.
I don't think they will. I personally,
they get close.
I don't. Nothing's really close. I don't see it happening. We've talked before about good assets to inherit and better assets not to inherit. If you've got a home that is going to go to your kids, let's say, after you're gone. I know some people who have sold those homes and then given the kids the cash when they die. But isn't it better for the kids to just inherit the home to get a step up in basis?
Well, it depends on how close to passing away the parents were.
Well,
I mean, if it was 20, 30 years.
Well, no, I'm talking about somebody who's,
Well, where I see this more often is where somebody puts the title in the name of the child.
Yes, and there's no step up there either.
There's no, because what did that individual own when they passed away? They didn't own the house anymore.
Yeah.
So that is a gift during a lifetime, is a carryover basis.
Yeah.
If your parents paid $50,000 for the house back in 1975, and it's worth $500,000 now, and they change ownership and give it to you now, your basis is whatever their basis was,
because
$50,000 plus the pool plus. But if they pass away, they get the new step up. They get the new basis from today.
Yeah, under current law.
If they own it when they pass away.
Yeah, under current law.
Under current law.
Which makes things like capital assets, I think, probably good assets for someone to inherit.
Typically, capital assets are.
Yes, if you inherit.
If I have a choice of inheriting, if somebody comes to me and says, I'm going to make you the beneficiary of one of three of my accounts. Only one, though. They're all worth $1 million. You get an IRA for $1 million, traditional, not Roth.
Right.
You get a stock account. Oh, by the way, the IRA is invested in the same stock.
Okay, got it.
Same mutual fund, whatever. Or you're going to get this annuity that I paid, $500,000 for. Which one do you want, Rick?
Rick wants the personal one.
I want the personal one. They're all invested the same, so I've got the same amount of risk. Let's take that out of the equation. So the question is, I only get one. I'm the favorite niece, favorite nephew.
Right.
I guess I'm identifying different. And my brother and my sister get to pick the remaining ones. Yeah.
So you're first.
I'm first for whatever reason.
You're taking the personal.
I'm taking the personal money because under current law, that means I get it tax free.
If you inherit
income tax free.
Well, we talked about what happens if you inherit an IRA.
Well, I'm going to have to pay tax.
There's taxes on
I've got the 10-year rule because I'm not within 10 years.
There's required minimum.
I'm not married to him.
Required minimum distribution.
But even so, I'm going to have to pay tax on that $1 million, whether it comes out over my lifetime, whether it comes out in one lump sum. That's a taxable event when the money comes out of the IRA. The annuity, that $500,000 of gain. Remember, I said they paid $500,000 for it. That $500,000 of gain is going to be taxable when it comes out. So which one would I choose? I would choose the one that's not taxable. That's just the greedy,
the one that has the step up in basis.
Step up in basis. Annuities don't get step up in basis. That's a tax deferred account. IRAs do not get step up in basis. They're tax deferred accounts. The money coming out of those, when they come out, the gain that comes out of those, regardless of how that gain was created, is ordinary income.
In general, if you only had two choices, IRA or annuity to inherit, which would you prefer? I guess it depends on the type of annuity.
Well, I mean, I can always move it, but I'm gonna. Right now, I'd take the annuity in this example because there's only $500,000 of gain versus $1 million worth of gain.
Right.
And with annuities, we have some new rules over the past decade where we can, take it out over a period of years. We don't have to take it all out in one lump sum.
Okay.
So, but again, I'm looking at the taxability.
Yeah.
Now, if somebody said, okay, let's go back, you have an IRA or the personal account, and we've seen this a lot where we're going to, mom and dad, grandma, grandpa, whoever, they're going to give, because it's very easy to name a beneficiary on an IRA. We're going to name little Johnny over here, the beneficiary, and we're going to name the Cancer Foundation, the
American Heart Association,
somebody
one of those,
as the recipient, the beneficiary of our personal money. We see this quite a bit. It should go the other way.
Yeah.
Assuming the dollar amounts are the same, or
sure,
give the IRA to the charity. If you're going to give $1 million to your kids and $1 million to the charity, give the $1 million IRA to the charity. Give the $1 million personal account to your kids. Kids don't have to pay taxes on the $1 million they get. Now we're ignoring any kind of estate taxes. We're just talking about income taxes. And then the IRA goes to the charity. And how much does the charity pay on that IRA? An income tax? Nothing.
Assuming it's a legitimate charity, absolutely nothing. Yes, let's
we
say
do make certain
501c3. Yeah, we are making that assumption as well.
So from an estate planning, asset transfer, and when we get up into the digits with multiple commas, we do see people making larger gifts to charity, especially when we get up into the 8-digit figure area, 10 million and above. They're going to give X amount. They may give their kids a couple million each. But they also, at that point, want to give a couple million to this foundation, a couple million to that charity, and things like that. And now it's just a matter of which one works the best, and how do we make it work?
If you got questions on this stuff, this is a big topic, and it seems to be big now, especially because of, so many baby boomers. The baby boomers are starting to go, right? I hate to say it, but
first year was what, 47?
46.
46?
46, which puts you almost at 80 here. And, you're 75. The youngest ones are about 75, and it's happening. And you have this sort of transfer between generations of different levels of wealth. And as Professor Plum just noted, in both the required minimum distribution arena and in the step up in basis and all this stuff, how you pass along those assets to your kids, even to your spouse in some cases, is important. You could wind up getting bitten by taxes. We didn't really talk about spouses. We talked about non-spouses. Spouses, I guess, Professor Plum, have a lot
more flexibility.
But there are still certain things you need to take care of from
you
spouse
still want
to
to reset the basis. You still want to do a lot of the things we were talking about. You just don't have that 10-year RMD rule.
Right, exactly. And then you have issues of, do I take my deceased spouse's do I put it in my name? Do I leave it in their name? And there are a whole bunch of reasons to do all this other stuff. But
and most of the time nowadays, we're not talking a lot about estate tax from a federal standpoint.
Well, it's so large. I mean,
but there still are states,
absolutely,
that have transfer taxes at death, whether they call them inheritance taxes, death taxes, estate taxes. They're it's all, to me, it's all a tax. If it's going to cost me money when money goes from one generation to another. But there may be ways around. That's where trusts come in, and using this, giving it here, but giving income. But we kind of gloss over that because from a federal standpoint, just to avoid income tax or estate tax, we just don't see the use of the trust like we used to. But for a control and an estate, a state, not estate, but a state,
STATE
level, you may still want to be doing some of that kind of trust work to avoid taxes at the state level.
It's always prudent to not just do it from a federal level, from a state level as well. This is why you talk to Professor Plum. This is so important. I honestly, people could wind up paying far more in taxes than they otherwise would have had to if they don't understand how these things work, like step up in basis, that their required minimum distributions have to come out under certain circumstances every single year, even as the beneficiary.
Now, we do have for somebody who died in 2020, their beneficiary, a 10-year or more than 10 years younger than them, not married to them, they've got the new 10-year rule. They were waived in 2020, so basically,
okay.
And in 2021, we had the guidance that said you didn't need to take any money out.
And then now we have
the guidance that says you do need to take it out starting the year after the year of death. Well, they weren't waived in 21. So all those people who didn't take anything out in 2021 who had somebody...
Are they subject to penalties?
By the strictest definition, they could be, but I cannot imagine the IRS doing that.
I can't imagine. No, because that was the guidance at the time.
That was the guidance, yeah.
That was the guidance at the time. I would hope so.
Talk about changing the rules midstream.
Well, this makes it even more important to have somebody like Professor Plum or any of the financial planners at Lucia Capital Group talk to them. If you are in a situation where you are potentially within the next, 5, 6, 7 years, 10 years or less, inheriting assets of any kind, whether it's a capital asset, whether it's personal money, annuities, anything like that, it's important to know what the tax implications are. And don't pay more than you have to.
We talk about getting your own financial life in order, but a lot of times we get a lot of our financial life from a generation above us that gets passed down to us. Mm-hmm. Have they put their financial life in order? Because it can be a gigantic pain to get all this stuff done if they're spread out, if they haven't got it straight. Yeah. So it's not an easy topic to talk to your parents and other people about, but it may be something, we're going through this. We're getting our financial life in order. Do you have any questions about what's going on with yours?
Yeah, a financial advisor can tell you things that they've run into, just like you did today in a couple of examples, that you may not have thought about. And it can help you save, potentially. Talk to any of the Lucia Capital Group advisors, 800-644-1150, 800-644-1150. This is what they do all the time. Professor, you seem to have this down pat, so it's
I'm
good.
Always looking up things and reading.
Well, you just saw, what was it in the last couple of weeks? I hadn't even seen it yet. You've got a closer ear to the ground than I do, but this new guidance, this does make a difference. Talk to them, 800-644-1150. We went a little longer today, but I think it's important to do that because, as I said, as this transfer of wealth increases and you have these capital gains taxes that people saw, a lot of them at the end of last year that they didn't expect, these are the things you need to look out for. Also go to luciacap.com. You can go to their website, luciacap.com, and find a lot of information there, videos, blog posts, articles. It's all there, luciacap.com. Also, Spotify. Don't forget, you can subscribe to our show, listen to our show, download it at your leisure. Spotify. I forget what the procedure is, but it's pretty easy. It just went out of my head. Go there. You'll find us right there. Thank you, Professor Plum. We got more to talk about next week. We may get into a buckets discussion. We've had a few questions on that. But in the meantime, enjoy yourself. Thanks so much for listening to this program. This is Managing Your Financial Future for Professor Rick Plum, Certified Financial Planner Professional. I'm your non-advisor host, podcast host, Johnny Dean. Thanks so much. We'll talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License number 0518721. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59 and a half, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.